Hi class. Today we're going to have a brief overview of Chapter 3. So these are some of the PowerPoints that are posted in our class in Blackboard, and they're not all in this presentation. I tried to whittle it down so you would not have to listen to me talk forever, but I did want to hit the high points of the chapter. So today we're going to be talking about adjusting and closing entries, and we're going to start out with recognizing that revenue and expense reporting don't necessarily happen when cash changes hands. Instead, revenue is recognized in the period in which goods or services are provided to customers, and expenses are reported in the same period as the revenues that they help generate. The revenue recognition principle is the principle of revenue recognition that I just spoke about, and the matching principle is the principle that states that expenses and revenues are generally reported in the same period in which they relate to each other. So this makes more sense, I think, with this example. So we're looking at expenses and revenue for a cruise ship. So we see this timeline from March through May. In March, the cruise company purchased supplies for the cruise that was to occur in April. In April, the cruise actually occurred. They had to put fuel into the cruise ship, and that was an expense that occurred in April. And then the cruise was given to customers in April, so customers paid for that cruise during April. And in May, the employees of the cruise company actually were paid for their services that they completed in April for that cruise that occurred in April. So we see that we have expenses in March, April, and May for revenue that actually was recognized or occurred in April. So all of those expenses and the revenue would occur or would be recorded during the month of April when they are matched up. And this is true regardless of when the cash was changed hands. So in the case of the salaries, cash didn't actually change hands until May. The supplies were paid for in March perhaps, and even the revenue, customers could have booked and paid for that cruise a year ahead of time, but the revenue would only be recognized in April when it's earned. All right, so the accounting cycle that we see here is January 1st to December 31st, and that's a calendar year. That's not necessarily when an accounting cycle occurs. It doesn't have to be on a calendar year, but typically they are on some sort of fiscal year basis. Now, there are circumstances where an accounting cycle is longer than a year, but for the purposes of this class and this book, we'll be looking at accounting cycles that occur over a 1-year period of time. So during that year of the accounting cycle, the company is going to record and post transactions that they engage in, and those transactions are the type of transactions that you studied in Chapter 2. At the end of the year, they're going to record adjusting entries that are internal transactions that are adjusting accounts to reflect accurate financial measures, and you'll see more about that as we go on. The other thing that's going to happen is that the company is going to prepare financial statements, and you've seen those as well as we've studied Chapter 1 and 2. And then finally, the company would record closing entries, and we'll talk about those in just a few minutes. So the types of adjusting entries that we're going to look at in this particular chapter fall into four categories: prepaid expenses, deferred revenues, accrued expenses, and accrued revenues. So there are some types of transactions that occur during the period, but we may not have recorded them during the period. Or sometimes something may occur after the end of the period that we need to kind of pull back into this current period and record it. So we're going to look at each of these four types of adjusting entries as we proceed. So here's a list of external transactions, and these 10 transactions would have been recorded by the company during the year or during the month of December. So these transactions would already have been recorded. There are sometimes when we have expenses that we prepay. For example, we could decide that we want to pay our rent out in the future, so we may pay 3 months worth of rent. Well, we haven't used that space for 3 months period of time. We're actually purchasing the right to occupy that space in the future, so that we are prepaying the rent. That expense that is associated with rent actually becomes prepaid rent, and it is an asset to the company until that space is used. So we oftentimes record expenses or pay expenses ahead of time. Sometimes insurance we pay ahead, rent, or we could even pay some types of utility expenses such as gas for heating. We could pay that ahead of time. So if we're paying expenses ahead of time, they're assets until we actually use what it is we paid for. So we're going to look at prepaid expenses and how to adjust those at the end of our period. So here's an example for prepaid rent. So we have made entries for prepaid rent in the past. Cash paid for rent in advance. If we were to do that, if we were to pay for rent in advance, we would record prepaid rent as the debit and cash as the credit. So that is the entry we would have made to start with. At the end of the year, and in this example, we paid $6,000 rent for December 1st, and we are now at the end of December, and evidently it's $500 per month for rent. So we paid $6,000 for rent, and that's obviously more than 1 month's rent. However, at the end of December, we have used $500 worth of that prepaid rent. So if we've used it, it's no longer an asset to the company. So we need to do something to reflect that now we have $5,500 remaining in that prepaid rent account, and we've used $500 of that prepaid rent at this point at December 31st. So to do that, we would have made this entry. We would have debited our rent expense for $500, which is the amount of rent we used, and we would credit prepaid rent to decrease the value of that account down to $5,500. Here's another example of recording prepaid expenses that for something that we've used. So prepaid expense for supplies is also common. So in our example, we had $2,300 of supplies that we purchased, and we recorded that in our supplies account, which is an asset. By the end of December, we've used $1,000 worth of supplies. So at the end of December, we have $1,300 remaining in supplies. So we need to somehow record the $1,000 of supplies that we've used, and also decrease the value in our supplies account down to $1,300. So we would do that by debiting our expense account, which is supplies expense, by the amount of supplies used, and crediting supplies for $1,000. Now, often students make a mistake, especially on this one where you're adjusting supplies, and they'll adjust supplies for the ending balance. You don't adjust supplies for the ending balance. You're adjusting supplies for the amount that is the difference between the beginning and the ending balance. Whatever you have left at the ending balance, you still have left, so it's still an asset. So this should be the ending balance, not the adjustment. So be careful when you're doing your homework that you're actually adjusting this amount of $1,000 and not the $1,300. That's the ending balance. Okay, here's an example of adjusting the value that we have in equipment. So it says on December the 1st, we paid $24,000 to purchase equipment. So if we had recorded that entry, we would have debited equipment for $24,000 and credited cash for $24,000. Now, equipment's a little bit different because we record equipment at cost, and then we do what we call depreciate it to record the value of the equipment we use, because we're not actually losing pieces of the equipment. Like it's supplies, we have a supply closet. When we use it, we physically have less supplies. With equipment, we don't physically have less equipment. We're just making use of that equipment so that it has less value. So we're using up some of the life of that equipment. So we're going to record that by recording depreciation on the equipment. So in this example, we had $24,000 worth of equipment, and at the end of the year, it's only worth $23,600. So we need to record the expense of $400. Now, to record depreciation, the entry is always to depreciate your depreciation expense for the amount of depreciation, and credit the account accumulated depreciation for the amount of depreciation. So both of these accounts would be recorded at $400, which is the amount that we have estimated that we have used of the value of the equipment. So this is just a partial balance sheet that shows that depreciation, how it is shown on your balance sheet. So on your balance sheet, in your assets section, you're going to show all your property and equipment, and those amounts are always shown at cost. In other words, what did we pay for them? Whatever we paid for them, that's what they're going to show up here. So here's the value, the historical value of all of the equipment that we have at cost, which is $40,691. We would subtract from that accumulated depreciation, and in this case we have a balance in that account of $21,141, which gives us a net property and equipment of $19,550. So basically what this is saying is that you have equipment that you paid this much for, and you are subtracting the amount of the value or the life of that equipment that you're estimating that you used, which is your accumulated depreciation. So up to this point, we think we've used about $21,000 of that $40,000 worth of equipment, which leaves us about $19,000 worth of equipment left. Another kind of adjusting entry is deferred revenue. Deferred revenues occur when a company receives cash in advance from customers. So for example, if I am an attorney, I may charge my clients a fee to handle their case, and I would charge that typically up front. So I may charge them $3,000 to handle their case, and at the point that they pay me that $3,000, I may not have done any work at that point. So I haven't earned that $3,000. I will earn it in the future. If something were to happen today and I've charged them $3,000 and I suddenly decide I'm going to retire and I'm not going to hear their case, then it stands to reason that I owe them that money back because I haven't earned it. So for that reason, deferred revenues are liabilities, because until you earn that money, if something happened and you could not earn that money, you would pay it back to the customer. So it is a liability to the customer until you earn it. After you earn that money, then that deferred revenue can be recognized as just regular revenue. So we need to do adjusting entries to record deferred revenue when it is earned. So here's our example. We received $600 in cash in advance on December 23rd. We provided some of the services, so we've earned part of that $600, but not all of it. So we should, by the end of December 31st, we should show that we have $400 in deferred revenue or a liability to the customer, and we've earned $200 of that $600. So to show that, we would debit deferred revenue, and remember, deferred revenue is a liability account, so to decrease that liability, we're going to debit it. We're going to change that deferred revenue that's unearned into service revenue that is earned. So the $200 we've earned, we're taking out of the liability and we're putting it into that revenue account. And this is just a partial balance sheet that shows that. So deferred revenue is a liability. It's typically a current liability, so it's going to show up in the liability section of your balance sheet. So you can see it in the second line down. All right, accrued expenses are another type of adjusting entry that we have to take care of. Those accrued expenses are recorded when a company has a cost that it's used to produce revenue, but that it hasn't yet paid for that cost yet. So in our cruise ship example, we actually went on a cruise in April, but we didn't pay our employees until May. So that expense, it would be considered an accrued expense because those salaries relate to the cruise we had in April, even though we haven't paid the cash for them yet. So here's another example. It says by the end of the year, $300 in salaries have been earned by employees but not paid. So on December 28th, employees earned salaries of $300 between December 28th and December 31st. And this is very common, especially for weekly or biweekly employees. they may work a few days at the end of one year, and the payroll period doesn't end until the next year. So lots of times you'll have a few days that are actually expenses for one year, and then the rest of the payroll happens in the next year. So we're kind of straddling fiscal years, and so we have to record pieces of the payroll in 2 different years, part of it in the previous year and part of it in the current year. So here's the rest of our example. We see that the other $400 that the employees earn is earned in the following year for a total of $700 in salaries. So to record the adjusting entry, and remember this is December 31st, so on December 31st we need to reflect that we owe $300 in salaries to our employees. So we're going to record the expense of $300, and we're going to record the liability of $300. All right, and accrued revenue is another type of adjusting entry we need to take care of. Accrued revenues, when a company provides products or services, but they haven't been paid for those services yet, then we're recording revenue even though we may not have been paid yet. So if you think about if I'm providing an audit for someone, I may provide an audit this year, and I may finish up that audit on December 31st, but the company that I'm auditing may not pay me until January. So I haven't actually been paid for that service, but I have earned that revenue. So we need to record those revenues that are earned. All right, so this says at the end of the year, $700 of services have been provided but not yet billed. So between December 28th and December 31st, we've earned $700, and we don't actually get paid for those revenues that we have earned until January the 8th through the 14th, so later on in the next year. So to record those revenues that we've earned but not yet been paid for, we're going to debit accounts receivable for $300 because someone owes us that money. We will receive it later. And service revenue, we're going to credit for $300 because we have earned that revenue, so we want to record it. And this is just a picture of an adjusted trial balance. So you've already seen a trial balance, and a trial balance is just a list of all of our accounts along with their balances broken out either into debit or credit balances. An adjusted trial balance is the same thing, except for the adjusted trial balance is the updated trial balance after you've done your adjusting entries. So once you've recorded your adjusting entries, you would then again list all of your accounts with their adjusted balances, and it would look something like this. And again, at the bottom, you should have equal debits and equal credits because that's just a rule of accounting. Debits always have to equal credits. If we're adjusting things in each of our adjusting entries, our debits and credits were equal, then our adjusted balances have been adjusted by the same amount, either debit or credit, and so those debits and credits still have to equal. Just as a reminder, your assets are typically listed first. You'll see an accumulated depreciation is actually a contra asset, so it gets lumped up here with the assets. Your liabilities are listed next. Your equity accounts are listed next, then revenue, and then expenses. All right, and I kind of like this chart because it shows how all of these things show up on the financial statements, which we have been doing. So you would adjust your books and then do an adjusted trial balance, and then use that adjusted trial balance to actually create your financial statements. So we would have our adjusted trial balance, and we would use these accounts and these amounts to do our financial statements. So if you recall, we are going to do our income statement first. And so if we look at our adjusted trial balance, if we've done it correctly, we should be able to find our revenue account. And from the revenue account down, all of that should go on the income statement because revenues and expenses go on the income statement. So if you can find the revenue, everything down below it should be expenses. The next thing you're going to do is your statement of stockholders' equity. So if you can find your revenue account, just above the revenue account, you'll find your equity account. So your common stock, your retained earnings, and your dividend account are all right above that revenue account, and those go on the statement of stockholders' equity, along with the net income that you have calculated from your income statement. After you finish that, you should do your balance sheet, And your balance sheet accounts should be everything else that's left, essentially. So all of your assets, all of your liabilities, and technically these equity accounts are on your balance sheet. They're also on your statement of owner's equity, so you would carry those over to your balance sheet. So this is just a picture of the balance sheet, so you can see here's our revenues, our expenses from our adjusted trial balance, and we have a net income. That net income carries over to the statement of stockholders' equity, and we've calculated our new balances on our common stock, our retained earnings, and our total stockholders' equity. And then those amounts carry over down here on the balance sheet, and then everything else on the balance sheet comes from the adjusted trial balance. So the adjusted trial balance is just a really easy way to keep up with the accounts as you're pulling them over into your financial statement. And then, of course, the fourth financial statement that we would have is our statement of cash flows, which we have not done yet, but we will take a closer look at that later in the semester. And after we do our adjusting entries and we create our financial statements, at that point we're going to record our closing entries. So we have some accounts in our chart of accounts that are temporary accounts, and some accounts that are permanent accounts. So I like to think of it as this. I have a mortgage on my home, and I owe the bank for the value of that mortgage. And on December the 31st, there is a balance to my liability, which is the mortgage. I owe some amount to the bank on December 31st. When I go to sleep at the end of the year and wake up the next year, unfortunately, I still owe money to the bank, and it's whatever I owed on the night of December 31st, I still owe on the morning of January the 31st. That doesn't go away at the end of the year. So there are some accounts in accounting that are permanent like that, like my mortgage account. They roll over from year to year, and we don't ever like zero them out and start over. So asset accounts, liability accounts, equity accounts, those are permanent accounts. Now there are temporary accounts that we actually zero out at the end of the year and get them ready for the next year. And in comparison to my example with mortgage, a temporary account to me is like my W-2. So my employers give me a paycheck every week, and on that paycheck it says I earned X amount for this week, and it usually gives me a year-to-date total. So by the time I get to December, I have totals on my check stub for everything I've earned throughout the year. And then at that point, my employer would create a W-2 and give me a W-2 for everything I've earned for this year. And then on January the 1st, my employer starts all over again. So they don't add my W-2 from this year to last year to the year before that. They start a new W-2 and new payroll records for the beginning of the year. And that is income to me personally, and that income resets at the end of every year. Well, temporary accounts in accounting behave in the same way. So when we measure revenue and expenses, which ultimately will tell us how much net income or net loss we have for the year, we measure them in terms of a year. So if we have a net income for this year, we've measured that in terms of this year. We'll zero those amounts out, and we'll start measuring net income again at the very beginning of the next year, and we measure it for that year. So we need to do something to zero out those revenue and expense accounts so we can start fresh with our revenue and expense and net income calculations for the coming year. So to do that, we're going to have to close out those temporary accounts. And when we get ready to close out our revenues and expenses, we're going to close those into retained earnings. So closing entries, we've got three categories here. We're closing our revenues in step A that you can see. In step B, we're closing our expenses. And then in step C, we're closing our dividends. So to close a revenue account, you're going to find the balance of that account, and you're going to do the opposite of what the balance is. So if we have a debit balance in something, to get rid of a debit balance, we're going to credit it. If we have a credit balance in something, to get rid of that credit balance, we're going to debit it. So for revenues, to close out revenues normally have credit balances. So to get rid of a credit balance, we have to debit it. So here we're debiting our revenue for the total of that account, which is evidently $7,200, and we're going to move that balance over into retained earnings. We're going to follow the same process for closing our expenses, except for, remember, expenses are normally have the opposite balance of revenue. So expenses normally have a debit balance. So to get rid of the debit balance, we're going to credit it. So in this step, we're going to find all of our expenses, and we're going to credit each of those expenses by the balance in those accounts. Once we record all of those credits, we're going to add them up, and we're going to debit the total into retained earnings. And once again, pay attention that your debits and your credits are equal. And then step C, we're going to close out the dividend account. So dividends normally have a debit balance. So to get rid of that debit balance, we're going to credit it. So we're going to credit our dividends for the balance of that account. And we're going to move that over into retained earnings. So we're closing revenue, expenses, and dividends all into retained earnings in these three steps. So up here you can see the balance in our retained earnings account. And retained earnings is a permanent account, so normally it would have a beginning balance. In this case, this evidently was a new business, so there was no beginning balance. So we have a zero beginning balance. This $7,200, we've closed out our revenue. Here's our 6,000 where we've closed out our expenses, and the 200 where we closed out our dividends. So if you think about retained earnings, normally has a credit balance, and that's the retained earnings is the equity that's still remaining in that account in the company. So equity accounts, a credit balance shows an increase in equity. Debit balance shows a decrease in equity. So if you remember how our revenues and expenses are closed here, you'll see that the revenues are in the credit side of this equity account, so they're increasing revenues, which makes sense. Revenues should cause equity to increase. Expenses are in the debit side of this equity account, so it's causing this equity account to increase or to decrease, which does make sense. Expenses should cause our equity to drop. And dividends the same way. If we're paying dividends out, we're decreasing the equity that remains in the company, so that causes this equity account or capital account, if you want to call it that, to decrease. Now, after we complete our closing entries, we do another iteration of the trial balance, and this trial balance is called the post-closing trial balance. So it is just a list of all the account balances after you've done the closing process. The great thing about this one is it's probably going to be the easiest thing you're going to do in this class because it's very short, and it is just a list of the accounts that have balances along with their balance. And so you'll notice we have our asset accounts at the top, our liability accounts all the way down here, and then our two equity accounts, common stock and retained earnings, and then we stop. Our revenues and our expenses are not on this trial balance because we've closed them out, so they have a zero balance, so they don't even appear on the post-closing trial balance. So this one is fairly short. You should be left with accounts that are either assets, liabilities, or equity accounts. And again, your debits and credits should be in balance. So that's the end of Chapter 3. I know this was a really brief overview, but hopefully this will help you as you do your homework and study this chapter.